All right. So you've heard about the recent stock market crash, and you probably think that it all started when President Trump dropped what many are calling a financial bombshell. And he declared it Liberation Day and announced some major tariffs that would affect pretty much everything in our economy. However, the market correction already started back on February 21st when the S&P Global Composite PMI showed a significant drop in business output demands and sales, and how business input costs significantly increased due to tariffs. And keep in mind that this was all on February 21st when Dow was down over 700 points in one day. My private community members know this because they get these alerts every day. And you can also join the private community by visiting 560.com/community. But during the market crash in April, about $6.6 trillion, and yes, trillion with a T, vanished from the global stock markets in just 2 days. And yep, that actually happened. And you're probably thinking, another market crash. Didn't we just finish paying off the therapy bills from the last one, right? So let me walk you through what happened real quick and why it hit so hard and fast and how the world reacted. And more importantly, how you and I could respond every single time the market decides to throw a tantrum like this one. All right. And fortunately, the market is taking a breather right now when President Trump put a pause on the tariffs when the bond market sold off. And let me show you what he said.
Was it the bond markets that persuaded you to reverse
No, I
course?
was watching the bond market. The bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. The bond market right now is beautiful. But yeah, I saw last night where people were getting a little queasy. I think everything had. Well, the big move wasn't what I did today. The big move was what I did on Liberation Day. We had Liberation Day in America. We're liberated from all of the horrible deals that were made, all of the horrible trade deals that were made.
Clearly, President Trump was watching the bond market sell off when the 10-year Treasury yield finished the day with 3.87 to 4.47, which was a massive 60 basis point jump in just one day. Now, the market crash all started after the market closed on April 2nd, and when President Trump dropped the hammer announcing massive new tariffs. And we're talking a base 10% on most imports, but it didn't stop there, right? And countries like China, they got slammed with the jaw dropping 145%. So what do you expect from the investors? Of course, they panic hard. In fact, over the next 2 trading days, the Dow dropped more than 4,000 points, which is nearly 9.5%. As for the S&P 500, it fell 10%. And the NASDAQ down 11%. It was like watching a house of cards in a wind tunnel. And get this, for the first time ever, the Dow lost more than 1,500 points 2 days in a row. And that has never happened before. And by April 3rd, this thing went global. And suddenly it wasn't just the US feeling the pain, but Hong Kong's Hang Seng Index had its worst single day fall in nearly 30 years and down over 13% in one day. And now that's not just a dip, right? That's a nosedive. So as you can see, this wasn't just another bad Monday, but it was a full-blown financial earthquake, and the kind that rattles your confidence. And even if you've been through a few market storms before, we haven't seen this much fear in the market since COVID shut down the worldwide economy. But right now, the mood on Wall Street is tense, to say the least. Investors are jittery. The ultra wealthy are basically calling their hedge funds and say, just cash everything out. I don't care about the fundamentals, just go ahead and cash everything out. President Trump's Liberation Day tariffs have thrown a wrench into the markets, which creates a cloud of uncertainty that sent stock prices tumbling and the VIX skyrocketing. And in slowing economic growth, sticky inflation, and fears of a looming recession, and you've got a perfect storm of panic. And as expected, the sentiment has taken a sharp turn south. And almost 60% of investors in the AAII survey say they are bearish about the next 6 months. And with the S&P 500 officially in the correction territory, people are fleeing to safer assets and not even US bonds right now, which is really crazy, is that people are not viewing US bonds as a safer asset. They're jumping to gold, potentially to Bitcoin or silver, right? And right now, folks are just not being cautious and they're straight up nervous watching every economic headline like it's a weather report before a hurricane. Now, there's this thing called the CNN Fear and Greed Index, which is basically a mood ring for the market. And before you say, oh, it's CNN, and just click out of this video, just hear me out for a minute about this data. It combines 7 key indicators from momentum and stock price trends to junk bond demand and volatility, and rolls them into one score between 0, which means extreme fear, and 100, which is extreme greed. When stocks are rising fast, the trading volume becomes strong, and people are piling into risky assets like junk bonds. So the needle swings, more towards greed, right? And we saw that in 2023 and 2024. But when investors rush into safe havens like, let's say, treasury bonds or gold or silver, volatility spikes and bearish bets outweigh bullish ones, and the index drops into fear mode. So basically, it's a quick way to see if the market's running on logic or raw emotion. Okay. But as I said earlier, what I think triggered a 90-day pause on the tariffs was because people started to sell out their US Treasury bonds. And historically, when the stock market sells off, investors put their money into bonds. But this time they sold off their bonds on top of the stocks. And selling out US bonds is even worse because it drives up interest rates and makes borrowing money more expensive for the government, consumers, and businesses. And that's also a signal to the US government that investors from around the world are losing confidence in the US and the US economy. And US treasuries have been known to be a safe haven investments. But when you add instability in the US economy, investors could be flocking to commodities like gold, silver, or even crypto. Now is a good time for you to start paying attention to the bond market if you haven't already, because bond ratings could also drop if the credit agencies start to lose confidence in the US bonds, right? And the other crazy thing that happened was when the markets tanked like they did after Trump's tariff shock, margin calls came in flying like unwanted texts from your ex, right? And loud, stressful, and usually at the worst time. But if you've never faced one, here's the gist. You borrow money to buy stocks, but now these stocks have dropped and your broker's basically saying, hey, cough up more cash or we're going to sell your stuff, whether you like it or not. And you see, after the tariff bomb, margin calls spiked to levels we hadn't seen since the COVID crash. So that's why the markets continued to crash after April 3rd. And hedge funds got caught off guard, even the cautious ones. And as they rushed to sell and cover their losses, that selling pressure dragged prices down even more, and which triggered more margin calls, right? It was a vicious cycle. By April 9th, some of the chaos had settled, at least in the treasury space anyway, but the damage was already done. The forced selling frenzy helped turn an already sharp drop into one of the most volatile trading weeks in recent memories. And while the April 3rd crash felt like financial world was ending, history has a way of reminding us that markets do bounce back, and it just depends on the shock. And you surely remember the dot-com bubble burst. Well, at least I was alive for it, right? There are a lot of younger audience who has never experienced the dot-com bubble burst in March 2000 when NASDAQ lost nearly 80% of its value. Well, it eventually managed to claw its way back. And the 2008 crash, that was brutal. The S&P 500 didn't fully recover from its 2007 high for over 7 years. But when it did, it gained more than 250%. Then there's the COVID crash in 2020 when the market fell off a cliff and then sprinted back to its pre-pandemic highs in just 4 months. So what makes the difference? It usually comes down to how bad the damage is, how fast the government or the Federal Reserve steps in, and how quickly investors stop panicking. In the case of April 3rd, the recovery could take longer since the tariffs are broad, painful, and provoke global retaliation, especially from China, right? But here's the good news. If history has taught us anything, it's that markets have always trended up over time. So here's what I'm doing. And do not flinch, right? Don't flinch. Stay the course, because bottom line, patience is what turns crashes into opportunities. So here are 10 things I remember to do every time we go through a stock market correction or a stock market crash. Step 1, that is to stay calm, right? And avoid panic selling with everyone else. And don't jump off the bridge or don't jump off the cliff just because everyone else is. Now, I'll be honest, when the market takes a nosedive, even I feel that jolt of a little bit of panic, and it's a human reaction. And that voice in your head says, just get out before it gets worse. But every time I listened to that voice, I regretted it, And back in 2008, I watched my portfolio crumble like a house of cards in a hurricane. And I only had like a little bit in my TSP at the time, but just watching that portfolio just drop by 10, 20, 30, and then eventually to 40%, it really hurt, right? And in 2020, the same thing happened. Fear was thick in the air. And now in 2025, it's deja vu all over again. But here's what I learned. Those who stay calm, those who don't slam the panic sell button, are the ones who came out ahead, and they will, right? And I've seen it too many times. And who better to illustrate this point better than Warren Buffett, whose quote sticks with me when he said, "Be greedy when others are fearful." And right now, fear is everywhere. But that's exactly why I am staying put and keeping my eyes open for opportunity. And step 2 is to log in to every investment account and write down what you're investing in. And a lot of people forget to do this. And how much money is invested in the S&P 500 or NASDAQ? How much of your portfolio is allocated to individual stocks, bonds, or something that is too risky? Just don't react impulsively. So in moments like these, when headlines are screaming, stocks are sliding, the first thing I do is pause, then log into every investment account I've got. My 401k, Roth IRA, brokerage accounts, you name it. And I pull up the numbers and make a full list. How much is in index funds like the S&P 500? What percentage is in individual stocks? And how much I've got sitting in bonds or cash? And I've learned that guessing or going by gut feelings during a crash is a recipe for bad decisions. And what I'm doing in this step is to just have a clear understanding of how my overall portfolio is structured. My 401k may be really heavy in the S&P 500, while my Roth IRA is heavy in something else. And that's why I log in and write everything down to get the final numbers about my investments. And step number 3 is to run risk management on my portfolio. Is my portfolio too risky for the market crash? Do I need to reallocate some of my portfolio to stay diversified between stocks and bonds? Now that I know what's in my portfolio, I ask myself, is it still aligned with my risk tolerance, especially after the April 3rd crash? Maybe you realize you weren't as comfortable with volatility as you thought because you're too close to your retirement age. What I did was that I took a moment to reassess my allocation. Was I too exposed to sectors hit by tariffs? Or was I too concentrated on one area? Maybe I have too much in commodities. Maybe I have too much in energy. And this is where diversification comes in. It isn't just a fancy term, but it's my safety net. And what I'm doing is possibly keeping my portfolio as is. And the new contributions that go into my portfolio will go into whatever index fund or ETF that is down by 10 or 20%. So I'm buying them at a lower price. So good risk management isn't about eliminating risk, but it's about taking the right risks for my goals and comfort. And financial education is everything when it comes to a time like this. You can schedule a session with me by visiting firesightchair.com/consultation, and I'll put the link in the description below. And step number 4 is if you are close to your retirement age, you have to ask yourself if you have enough cash or cash equivalent assets to survive a bear market scenario. Do you have enough cash set aside to pay your bills if you want to avoid taking money out of the stock market? Now, if you're within the 5-year window of retirement, this step is crucial. And because market crashes can trigger what financial experts call sequence of returns risk, like having to sell investments at a loss to cover living expenses, which can seriously hurt your retirement savings, right? And the key question is, if you have enough liquid assets to cover 1 to 2 years of expenses without dipping into stocks, the cash buffer gives your portfolio time to recover while you keep your lifestyle intact. And I talk about the importance of cash reserves and multiple income streams, but some people still feel like cash is trash. It's trash if you're not properly planning for it. And you probably don't want to have too much cash if you're decades away from your retirement age, but you want to have the right amount to account for these market crashes when you get closer to your retirement age. So if you're approaching your retirement age and don't have this cushion, there are ways to gradually build one by shifting new contributions into safer assets or selling positions during market rebounds, not when everything is down like you're seeing right now, right? And Step number 5 is to stay on course with your FIRE plan. Are you still maxing out your 401k, HSA, or Roth IRA? Are you still saving 25% of your income towards your retirement? Now, when the market feels like it's collapsing, it's tempting to pull back on retirement contributions or ditch your savings plan altogether. But that's actually the worst thing you can do. And in fact, during downturns, your regular contributions buy more shares at lower prices. And this is a strategy that we all know, and we financial nerds call it dollar cost averaging, right? Now, after the April 3rd crash, I know people who continue to keep maxing out their 401ks, HSAs, and Roth IRAs. A friend of mine even increased his 401k contribution from 15% to 20%, knowing he was now buying stocks at a discount. And if you were saving 25% of your income for retirement before the market took a nosedive, don't change a thing unless your personal finances have dramatically shifted. And think of it this way: the market's on sale and you're getting more shares for the same dollar. And it's a buying opportunity. It's plain and simple, right? And step 6 is to start looking for different opportunities to invest in something that is selling at a discount. And take a look at what sector is underperforming. Now, as I've mentioned earlier, Warren Buffett's advice to be greedy when others are fearful rings especially true during market crashes. After the April 3rd tariff announcement, defensive sectors like healthcare, utilities, and consumer staples held up better than others, but nearly everything else took a hit. And maybe you want to pay more attention to the domestic manufacturing companies that could benefit from tariff protection, as well as multinational corporations that got punished too harshly despite having the scale to handle trade disruptions. And I always have a shopping list of high quality companies that I've always wanted to own, but I thought they were too pricey to own at the time back in 2023 or 2024. Maybe some tech stocks could drop another 10 to 15% during the panic, which creates a potential long-term opportunity. But be selective and disciplined. As one of my mentors always said, not everything that's falling in price is a bargain, and sometimes it's just broken. And that's why it's best to focus on companies with strong balance sheets, steady cash flow, great income statements, and the ability to weather economic storms, right? Just because stock A is on sale, it doesn't mean that you should buy it, because it might just be one of those bad business plans that the company has and potentially going bankrupt. That's not something that you want to invest in, right? And step 7 is to keep investing on a regular schedule and try not to deviate from your investing schedule. And when the market's in chaos, consistency becomes your secret weapon. While everyone else is stressing over when to buy or sell, just stick to your regular investment schedule. And someone I know considered rushing his April contributions to his 401k to catch the bottom. But by doing so, he would have missed the employer matches in November and December if he maxed out his 401k too early. He decided to change his mind, and by doing so, he avoided the stress of trying to predict the market's next move without missing out on his employer match. Now, regular investing during downturns is like catching raindrops in a bucket. You don't need to catch every drop perfectly to collect plenty of water. And believe me when I say that the real power behind this approach is psychological. Okay. By sticking to your routine, you train your brain to see market volatility as a normal part of investing and not a crisis requiring drastic action. And some of the best investing fortunes were not built on perfect timing, but on consistent, steady contributions, especially when others were abandoning their plans. And step number 8 is to recalculate your 5-year projection based on this year's stock market performances. And if you're on the financial independence retire early path, like I am, market downturns call for some honest recalculations. And if you've been dreaming of retiring at 45 based on 10% annual returns, it's time to factor in for this year's negative performances. And in my private client program, I have this very comprehensive FIRE tracker that shows my clients where they are on their FIRE journey. And I'm a very visual person, so I like to show these charts and bars. But what really matters is how this year's market performances could possibly delay someone's retirement goal or maybe speed it up when the market recovers. And naturally, some people are going to feel discouraged now, but understanding their long-term plan is going to matter a lot. So you see, this isn't about giving up on your FIRE dreams. It's about grounding them in reality. right? You've been putting your spreadsheet at 10% average annual return. Maybe you need to adjust it to 8% or 9% to be more conservative. And market crashes are part of the investing journey. And factoring them into your projections is not pessimism. It's just smart planning. And clients who regularly update their fire plans, accounting for both good and bad market years, tend to be more resilient and adaptable. They realize that the road to financial independence is not a straight line, but with patience, it'll still lead them to the destination. And going into step 9, let me tell you why market downturns are a great chance to reinforce your financial foundation. And in fact, I go over my clients' expenses and monthly cash flow and look for areas to cut back, which can help them free up more money for saving and investing. I remember helping a client of mine when she found out she was spending like over $200 a month on subscription services when she had an Amex Platinum credit card that reimbursed about $20 a month for Peacock and Paramount Plus. And she also has a Verizon account that could get a Disney bundle for free, and that's saving her another $25 a month. And there are so many ways to save money, right? And beyond trimming expenses, it's important to assess your income stability in a shifting economy. And could tariff-related changes affect your industry or job? Are there opportunities to create extra income streams to protect against job uncertainty, right? And the bottom line is that a solid financial foundation brings confidence during market turmoil. And when you know your basic needs are covered, you can make investment decisions from a place of strength and not fear, right? And lastly, if there is one lesson every market crash teaches, it's this: trying to time your entries and exits perfectly is a fool's game and usually leads to underperformances. And because past studies consistently show that missing just a few of the best market days can significantly hurt long-term returns. And during the April 3rd crash, we saw this in action. Markets plunged but bounced back after 2 days. Those who sold at the lowest missed that recovery, right? And the catalyst for this surge, well, President Trump decided to hit the pause button on those new reciprocal tariffs, at least for 90 days, and most countries are off the hook except for China. And let me tell you, investors were more than happy to welcome this breather. And they've been seriously stressed about how these tariffs might mess with the economy. So when the news broke, they rushed back into the market like it was Black Friday. And the result? Some pretty wild gains, right? The Dow shot up nearly 8%, the S&P 500 jumped more than 9.5%, and the NASDAQ absolutely crushed it, up over 12%. Which I haven't seen since it was like 2001. And it was a massive comeback from the edge of a bear market. And that said, everyone knew the celebration might be short-lived since the pause was temporary and the trade tensions with China were still heating up. And as you can see, the market as of today are dropping by about 2% for the NASDAQ, and Dow is down about 400 points. And the bottom line is that you'll never know when the rebound will happen. And it can take place in a couple of days or even weeks or months, maybe a year, maybe 18 months. So instead of trying to predict short-term movements, you need to focus on time in the market, not time in the market. And if you're worried about volatility but still want to invest, consider spreading your investments over several weeks or months to dollar cost average your contributions. This gives you more psychological comfort while keeping you in the game long-term. And remember, successful investing is more about managing your behavior than trying to outsmart the market. Now, the recent stock market crash was a stark reminder that markets don't always follow predictable patterns, and they can shock us, test our resolve, and challenge our beliefs about investing. But amid the chaos, here's something powerful to keep in mind. Every single stock market crash in history has eventually been followed by new highs every single time, every single one. And the investors who come out on this volatility are not those with magical foresight, right? I don't have a crystal ball to tell you that the market is going to go up tomorrow or, in a month or maybe next year. They're the ones with unwavering discipline and emotional resilience. These are the people who stay disciplined no matter what the economy is doing, no matter what the market's doing. Your financial future is not shaped by events beyond your control. It is determined by the thoughtful decisions you make during times like these. So by staying calm, maintaining perspective, And sticking to the timeless principles we've discussed, you're setting yourself up to not just survive the market turbulence, but potentially thrive in its aftermath. Now, remember, the greatest transfer of wealth often happens during periods of extreme fear, from those who panic to those who persevere. And which side of the equation will you be on? The choice is yours. Stay invested, stay disciplined, and keep your eyes on the financial horizon and you're working toward, right? And this has been another beast of a video, and I hope you got a lot out of it.